You're listening to the Weekly Wrap-Up on Sprott Money News.
Well, greetings once again from Sprott Money News and SprottMoney.com. It's Friday, the 9th of February. It's been a crazy week in the markets, but this is your weekly wrap-up. I'm your host, Craig Hemke. Joining us to wrap it up is Eric Sprott himself. Eric, good morning.
Hey, Craig. Happy to be here. Lots of wild and crazy things going on, so let's try to cut through it.
We'll do our best, won't we? But hey, gold has been up and down this week, and I know you watch it like a hawk, and you've seen this week's crazy fluctuations. I think there's a great opportunity for our listeners to take advantage of this amazing deal that Sprott Money's offering. For a limited time only, you can actually buy a 1-ounce Royal Canadian Mint gold bar for only $19.99 over spot. That's about half off what the regular premium is. Now, it's open to Canadian listeners for home delivery or storage in Toronto, but American listeners can also take advantage of this limited time deal by purchasing and storing at Sprott Money's storage facility in Toronto. So here's what you do. You call 888-861-0775 or visit SprottMoney.com for more info. How's that sound to you?
Pretty good deal. I remember back in, I think it was 05 or 06, I had a lot of gold sitting at the Royal Canadian Mint in Ottawa. They had a little downtime, and they asked me if I'd convert my bars to coins, and I said, yeah, I might do that. What would you charge me? And they charged me $6.50. That was a huge, tens of millions of gold, at $6.50 an ounce. But that's when gold was like $400. So if you can do that at $19 at $1,300, that's a hell of a deal. So that's something that if I didn't already own as many coins as I need, I'd be right in there.
Yeah, no doubt about it. I'm sure, especially our Canadian listeners, they know all about the 1-ounce Royal Canadian Mint gold bars, and to get them for $20 over spot, that's outstanding. And given the world as it is, and the way the markets are, and the way this year is shaping up, man, I tell you what, this is probably a good time to be buying some. Eric, we had a drawback in price this week, but that's probably more because of what's been going on in the equity markets around the globe. And that's probably all because of what's been going on in the bond market. So we'll just leave it there and let you pick up and run with it.
Sure. Well, I think you should always go back to first principles to try to figure out what just happened, okay? Because what happened has been very dramatic here with 2,000-point down days in a 4-day period. And, of course, what happened was that interest rates started rising. And some people put it down to the jobs report on Friday that you and I discussed. And by the way, it wasn't even that strong a jobs report when you took out the hours worked that fell during the week. But nonetheless, the market went on its way and raised rates. But when you step back and look at the interest rate environment, the U.S. government in particular, I mean, here you have the Fed saying we're going to be a seller of bonds. And then you have a budget thing passed this evening or this morning, and we're going to plunk another $300 billion on top of the debt. And if rates are already up a point, you have another $200 billion of interest. You finally say, well, how can rates possibly stay here? And I think that is by far the overriding story. Now, within it, and mostly on Monday, we had this blow up in short vol. And they were notes. I call them Goldilocks notes. Goldilocks notes are notes that people think, well, everything's going to stay the same, and I'm just going to sit here and clip coupons all the time. And then they find out that we're not in a Goldilocks environment. Now we're finding out we're in a wicked witch environment. And things, I think, are going to spread from the short vol to other things, let alone having margin calls and things like that, because unless the market goes down, I think rates go higher, and it's almost like you almost have to have the stock market go down to keep rates under control, and that's only for a very short time, because ultimately you got to do bond issues. I gather that the 30-year bond issue was just a joke. I think that was yesterday. Like the bid to cover was weak, and it's priced above new issue expected price. So I think all eyes should be on the bond market here, and follow and think about all the repercussions that could come through. We also saw that equity fund sales last week, I think, were something like, well, they're a record high for quite a while. I mean, they might even a record all-time high fund sales. So this is people cashing in. So I think to our listeners, don't get hung up in, whether we have inflation or deflation or stuff like that. I think we have a market, the bond market, that's out of whack here, where the people who have to buy the bonds are going to be outweighed by the people who are supplying the bonds, and the rates are going to go higher. And if the rates go higher, of course, the obvious impact on the economy and valuations. The economy and valuations is incredibly negative. So that's what we should all be watching for.
Let's stay there for a second, Eric, because there seems to be a real conundrum in that twice now the 10-year has gotten to this point of 2.88%. Now, why it's that point, I have no idea. We were 202 5 months ago, and now we're at 288. That's a tremendous move. It's a 40% move in that rate.
Right.
And it's twice it's gotten to 288, and twice the market has crashed. I mean, are we at a spot here where, we just can't have longer rates go any higher?
That's what the issue is, that because the mortgage rates move in lockstep with the 10-year, and all of a sudden, mortgage rates go up 80 basis points. Well, it makes everything unaffordable, right?
Yeah.
It was pretty skinny getting in the way it was, because by reducing down payments, by having low interest rates, you raise interest rates. Oh my goodness, the cost to the first-time buyer just explodes. So that's why, and it's not just the economic impact, as I point out about rates. It's the valuation, because we compare bond yields to stock yields. So if bond yields keep going up and stock yields are flat, stocks start losing the contest. So we all have to be very wary of it. And one of the things that I might point out to listeners, having been a person who has to trade in markets, and one of the worst things that ever happens to you in a market is you show your hand. In other words, you put the sell order in. Well, you're like a chicken going off to slaughter here, because the HFTs are just sitting there waiting for you. And they see your order coming in to sell, or it's put in by your broker because it's a margin call, and he doesn't hide the fact that he just wants to pound it. And then, of course, the HFTs jump all over it, and you get a faster decline than you would otherwise get. And this, of course, is one of the great weaknesses of the market, has been the whole non-regulation of high-frequency traders, which was great when things are going up. But it's going to be the opposite when things are going down, and you're going to get more extremes in daily changes. And I think that's part of it here. You got lots of people trading against you all the time here. And as we get more and more people kind of being forced to do things or panicking or whatever, then the HFTs just have a field day.
So, and one last question on this then, Eric. If we've reached a ceiling, if the 10-year can't go past, let's just call it 3%. Let's round up to 3%. If the 10-year can't go past 3% without crashing the market due to all the leverage in the bond market and everything else, and the leverage in the stock market, if the 10-year can't go past 3%, what does that do to all this, Fed goon stuff about how many times they're going to hike rates this year?
Yeah. Well, of course, it puts it all at risk, right?
Yeah.
And that's the question. When does the Fed step in? How low do they let the market go before they have to say, okay, well, maybe we should reconsider all of this? And of course, if the minute they say they're reconsidering, gold and silver will go crazy on the upside. But that's the risk they have. You either let it tank,
yeah,
and maybe there is some resolve there, Craig. It's hard to imagine there's resolve, but maybe there is some resolve at the Fed that they want to get these rates through. God knows why they would, because they're going to destroy the economy and the markets at the same time. But the risk we have, and it's very omnipresent right there. It's all negative for long holders in the stock market. Look, it's all negative unless the Fed capitulates. And we're not seeing much in the way of that, having listened to the Bank of England yesterday talking about, rates increases sooner, more often. Looks like Fed speak is likely to remain hawkish.
Well, we'll see. We're down. S&P's down 8% since last Friday, Eric. So if we're down another 8% by next Friday, we'll see how that changes. In terms of gold and silver, though, my friend, let's wrap up here. It's been a tough week. It's kind of the baby getting thrown out with the bathwater to some extent, and not unlike what we saw in 2008, where gold went from 1,000 down to 700 before going to 1,900. How do you feel about, we'll just call it the metals at this point,
Sure.
Given what we've seen?
Yeah. Well, I think, look, relatively, they've done well. I mean, I could sit here as a guy with a big portfolio, and I said, well, thank God my gold's only down 2% and my silver's only down 2%. Well, everything I could have owned could be down 8 or 10.
Yeah.
So I'm not hurting here. So I think relatively, these things have done exactly what we would expect. They've probably been suppressed. Like the natural instinct should be to buy gold in this kind of environment. We'll see what happens today here. Lots of people in the world are going to be trying to find things to invest in that can hold their own. And I think we're already seeing that gold and silver look like they're filling that role. And, to me, I mean, I love the fact that the cryptos have kind of crapped out here. We're in a bond bear market. And we're getting close to a stock bear market.
Yeah.
You couldn't ask for it any better for people to pay more attention to gold and silver.
Yeah, we're getting washed out in the Commitment of Traders report too, Eric. The new one today will probably show a pretty bullish configuration.
I would hope so.
Well, all right, my friend. It has been an interesting week. It is going to be another interesting week ahead, I'm afraid.
We're going to look forward to next week.
Yeah, I think you're right. I think it's intriguing to see all the machinations kind of back and forth between the Fed and the banks and the equity investors. It certainly gives us a lot to talk about, doesn't it?
It will do, for sure.
All right, my friend. Have a great weekend.
Okay, Craig. You too.
And from all of us here at Sprott Money News and SprottMoney.com, thanks for listening. Hey, be sure to go to SprottMoney.com and check out that deal. $20 over spot for a 1-ounce Royal Canadian Mint Gold Bar. That's a heck of a deal. Go check it out today. And we'll talk to you again next week.